Hey, welcome back. We've got a credit crunch in the United States, a debt ceiling, inflation is spiking, and home values are falling. So what does that mean? Well, today we're going to be looking at 5 dividend ETFs for 2023 to help you make passive income, that cash flow coming in every month or every quarter. So let's get into it. So if you look here on my left, I've got the presentation we're going to go over, and then I've also got the ETFs on the right. We're going to actually get into those real time. So which one is my first pick here? Well, that's SCHD. SCHD is the Schwab Dividend Equity ETF. Probably my favorite out of this list, although there is one at the end that I want you to stick around for. It's definitely a bonus. But the Schwab Dividend ETF, Equity ETF, focuses on high quality companies with sustainable dividends. What does that mean? So you've got the Apples, the Home Depots, the Verizons, the AT&Ts that are going to continue to give you those dividends with a track record of pushing those dividends up over the last 10 years. You've got fundamental screens. You've got a 10-year history of paying dividends, which is great. That's always something you want to look for. So don't just look at the first couple years. You want to go as far back as you can and see what that dividend looks like over the last, over the long haul. I already talked about it's got a diversified portfolio here. No individual security or equity can go for more than 4%. And each sector is capped at 25. So what does that mean? Well, it means that in here, if I go over here on the chart, top 10 holdings, it's 4% for one for Broadcom. We've got Merck, but then each sector can be no more than 25. So in this case, health technology, electronic technology, finance, retail trade, those are all set at a cap of 25%. The expense ratio, this is part of the reason that I really like Schwab, this SCHD so much, is the expense ratio is just very, very low. So we've got 0.06, and then as you'll see over here, it's got a dividend yield of 3.75. So what does that mean? So if you put $100,000 in throughout the course of the year, you're gonna make $3,750. That's the yield plus any appreciation on capital, as you hope SCHD has went up over the years. Now, if we go back here and look at the timeline here, if I look at the 5-year mark, SCHD's done extremely well. So 5 years ago, it was trading at $49.60, and now it's at $69.91. And if I go max, it's actually even better. When it was released, you'll go back here to November 2011, it actually is $25.65. So in the last 12 years, you've more than doubled your money, which is great. Inception, like I said, was 10/20 of 11. And it's an open-ended fund, meaning that you can continually invest and put money in, whether it's a lump sum or it's continual investing. They have 102 equities in here, number of the holdings that are in there. And then the price to earnings, which I've talked about before, that's the amount of each dollar you have to put in to actually realize any earnings from it. So for instance, Tesla was trading at 1.1,000 to 1. Price to earnings here is great. So this is probably my favorite ETF in the group, but let's continue. So the second one in the group is VIG. VIG is Vanguard's Dividend Appreciation ETF. It's great because obviously most Vanguard funds are very low from an expense ratio standpoint. This tracks market cap weighted indexes of US companies only. So you don't have any foreign investment. You don't have anything from China or Europe or anything like that. So there's no international exposure. So if you do want just American companies, this may be the ETF for you. They do have a track record of increasing their annual dividends for 10 or more years. This ensures investors are exposed and getting the right exposure, and they're also getting that appreciation on capital. It has an average return of 10.75 over the last 5 years, which you can see here. And the standard deviation is pretty low. And the dividend yield in this case is a little lower than what the Schwab is, but Vanguard has continued to do very well. The expense ratio in this case is 0.06 as well. So if you're looking, the difference between this one and the Schwab is, if you're looking for domestic exposure from United States companies, you'll definitely want to stick with this one. All right, number 3, DVY. So DVY is a BlackRock ETF. So it's not a Schwab and it's not a Vanguard. This is the BlackRock ETF. And I wasn't actually able to find it. I'm typically using ETF.com when I do all my ETF lookups, but for some reason it wasn't on there, possibly because it's owned by BlackRock. But very high dividend, very diversified. So you've got 100 stocks in here and strong performance. You've got a 12.2% average return over the last 10 years with a standard deviation of 16.15 and a yield of 3.32. So the yield of 3.32 is great. It falls in line with the other two we just went over. The PE ratio is 15.56, which is normal. And then the price to book is pretty low. No REIT exposure. One thing I do want to mention with the last two is you also don't have any REIT exposure. So if you are looking for something that will expose you to REITs or real estate, you'll want to avoid these ETFs altogether. As I move over here and I look at the overview, performance-wise over the last, since inception, 8.21% total return. You can actually look at the growth of 10,000 here. It's done extremely well. So if you actually had $10,000 since inception, which would have been back in 2003. You've not done as well as the benchmark, but you're up 339%. Which is great. Again, I'm a big proponent of set it and forget it, leave things alone, just let it go. Buy low cost index funds with a low expense ratio, good price to book and good price to earnings, and leave them alone. About 20 billion in assets in this fund here. We can see, like I said, number of holdings. We've got 100 in the actual ETF. It's been around for almost 20 years. If you're interested in some of this, I'll put the links for all these down in the description below, as well as I'm going to link this presentation down in the description. So if you'd like a copy of this, you're welcome to look at it. Like I said, management fee of 0.38, which is much higher than the others. So 0.06 to 0.38, you're looking at a 6-fold increase. So you want to be careful with that. DVY, I think, can be a good ETF for dividend income, but you got to watch the expenses. And then here's a list of all the different tickers that they have in there. So the biggest one they have today is Altria Group. Verizon's been known to have a great dividend, IBM, AT&T. I mean, you can pluck these out yourself and look at just individual names if you wanted to. You're looking at more risk. You're looking at higher risk from less diversification. Okay, number 4, we're going back to Vanguard, so VYM. VYM is the Vanguard High Dividend Yield ETF. This is popular for those seeking high exposure to U.S. high dividend paying U.S. stocks. So in this case, there's 3 things I want you to look at. Index exposure, it tracks the performance of the FTSE High Dividend Yield Index. And tracking a benchmark like that helps you to see, hey, where are you positioned and how could you, where could you have made more money? But it also having a track record of seeing, where things were and where they're going. So VYM has a higher P ratio and a little bit better price to book. It's a trading at a premium to the market, and it is. With a higher P to E ratio like that, you want to be careful looking forward. No REIT exposure again. So if you're looking for REIT exposure, you need to go outside of these ETFs so far. So it's just, something you need to be aware of. Its expense ratio, like most Vanguard ETFs, is extremely low, which is why Vanguard is extremely popular for ETFs. If I look over here, the VYM has an average return of 12.83 over the last 10 years and a dividend yield of 3.19. So this, along with the second one with VIG, those are great. They just comprise a little bit different companies. And then I put at the bottom, if you're seeking value and seeking exposure to high dividend paying stocks, the expense ratio is good. Just be careful on the high P to E. If I go over here on ETF.com and look at it again, I believe the fund inception was 2006. Yeah, it was 11/10/2006. You've done extremely well. It was trading back then at 52 and now it's 102. So you've doubled your money easily over the last 17 years. Let's go down here and look at some of the fund flows. That's one thing I haven't talked about so far is what is fund flow. So fund flow is a way to judge how much money is coming in and how much is coming out. So if I see a lot of money outflowing from a fund, I know that maybe this is not the fund I want to invest in. It could be. Likewise, if I see a lot of money coming in, it's either institutional investors or it could be some big names coming in. I may want to jump in there. This is all United States companies. You have more companies in the holding than you do with VIG. And some of the bigger ones are Exxon, Johnson & Johnson, JP Morgan, these big staples of the economy, the more blue chip stocks that you're used to seeing. And likewise, if you don't want to have too much in finance, so 20% of this is in finance. I do think this is very diversified across the sectors. So you've got consumer discretionary, process industries, mining, information technology, health, finance, and these are all great companies. I don't see them going anywhere. Just be careful of the expense ratio. Be careful of the high P to E ratio here. And if we move down here, again, it's an open-ended fund. You can invest whenever you want. Some more tradability options down here. And then if you want to look at anything else, like I said, I'll link this down here. Like I said, be careful of the high P and E. Okay, so number 5 is, we're going back to Schwab, SDY. This last one is, if you're looking for a stable performer, the Dividend Aristocrats Index may be a good option. So this is a dividend paying large caps. These are all large cap companies. So think Walmart, think Verizon, think AT&T. SDY also has an average return of 13.92% over the past 10 years. So I believe that's the highest in here. Standard deviation is pretty good. And then the expense ratio would be double what those Vanguards are, but you're actually getting higher returns. So again, you want to be careful of the risk for the expense ratio, but you also want to make sure that you're not shorting yourself when it comes to return. So it can be a bit of a balance. If I look here across the max of the portfolio, you're actually seeing from 2000, I think this was another 2005. Yeah, the inception date, 2005. You're looking at a return. So it was opened up at $53. So you've more than you're up about 250% from the time you bought in if you just did absolutely nothing. Again, doing nothing, set it and forget it, leave it alone, don't touch it, maybe do some drip, some dividend reinvestment planning, do some auto adjusting and or auto invest and just let it run, just leave it alone. If you did absolutely nothing, like I said, you'd be up over 250%. There has been a lot of net inflows into this over the last couple days. So my guess is that's due to the liquidity crunch, the credit crunch. People don't know what's going to happen to interest rates, so people are hoarding more cash and moving it out, which can potentially drive the price down, which as of today, on the day it's being recorded, it is down a little over 1%. So again, if you're dollar cost averaging and you're putting money in every month, every quarter, every year, those bumps down on the way up, that little trickle down then back up, it's not going to make a difference one bit. Now, if I go down here, you'll see, okay, 3M, IBM, Walgreens, Realty, Income Corporation. Those are some of the biggest holdings in here. You do get a little bit of real estate exposure, NNN, REIT here. So if you are looking for REIT exposure, real estate exposure, make sure you check out SDY because you will get that exposure through Realty here in this fund. Expense ratio, like I said, is 0.35. I'm sorry, I made a mistake over here. This should be 0.35, not 0.12. My mistake. 0.35. So you want to make sure that you understand the expense ratios. You understand that this is now 6 times what the Vanguard is. So if I go over here to one of these Vanguard funds, the expense ratio down here is 0.06. If I go back here, the expense ratio is 0.35, and you're not getting that much more of a average return, and the dividends not that much higher compared to what the Vanguard is. So I'm not saying you shouldn't invest. I'm not in this one. I'm not saying that you should. Just make sure you understand and you do your own due diligence. You understand, look for things like net inflows of cash. Make sure you look at expense ratios. Make sure you look at average return. Make sure you understand whether an ETF has a history of bringing money back into the fund. They're continuing to increase their dividend exposure. They're increasing the dividend year over year. If a company is reducing their dividend or it's not keeping up with the pace of inflation, you may want to look at something else. Now, I did promise we've got a couple others on the list. There's a few that I wanted to mention, some honorable mentions here. So if you want to go into individuals, things like Altria, Realty Income, Verizon, which we've seen, Omega Healthcare Investors, RioCan, and then Smart Centers, those have yields anywhere between 5 and 9.5%. Those are individual stocks, so you're not paying an expense ratio for that because there's nothing to manage. Those are individual stocks. Again, be careful though investing in a single stock, as that kind of kills your diversification. And if there's something wrong with this, or something happens with the stock, they miss earnings. Don't put all your eggs in one basket. Just make sure you understand the risks. So let me know which ETF you're looking at buying and why. Comment down below. I'm going to link this presentation and all this down at the end in the description. And as always, don't forget to design your financial freedom. Take care. Bye-bye.